Yeah, we have all the time we need.
Yeah, and if we need to, yeah, if I need to share my screen eventually, let's say I want to show you something there. I think we could
Certainly.
also do
Yeah,
that.
I thought the same. Yes, sir. I could just I will make you the host. You know how it works, yeah? You're on the right hand side, you click more, and then you make host. And once you make a host, you can share the screen. So let me give you the host now.
Yeah, let me be the boss.
Here you go.
Did you have like a hard stop or timeline?
Nope.
Or no? Okay. I'm the host. All right. Oh, I could pause the recording actually. Oh, cool. Cool. So that's gonna, so we won't have to edit. Let's say there's something happening. I'll just.
I think what we'll recommend is we can just record the whole thing. And then if you like, I do have a IT person full-time. And then you can just say from what second to what second, I want to take that segment out. And he's very good at it. All you need to do is just, I want to keep from this minute to this minute, from this minute to this minute to this minute to this minute. And if you want to even insert materials, you can say, that place, I want to add this chart. And you can give in like a GIF.
Wow. You have an IT guy. That's impressive.
Oh, I have 3.
Yes. Well, that's good questions. I'm so curious, man. So let me know if like stuff is out of bounds there, but.
Oh, no, not at all. You can ask about what I do during a day or how I run the company and how many IT person I have. Yeah. Any questions? Love it.
All right. Is it recording? No.
Yes, it is recording.
What? we should all of this we should show on the original. We shouldn't cut any.
If you like, no problem. You're the boss. It's your podcast.
All right, guys. I have a special guest. I've never done this before. It's you've seen me do podcasts with Kevin, North Star. We do charts with Garrett Goggin. Also, I did like live streams. But I've always like been curious to bring together the fundamentals or somebody that's really behind the scenes, like behind the charts, like whatever actions they do, does it really have an impact on the charts, or is it the charts that's guiding the management? So I introduce John Lee from Silver Elephant. Thank you very much for accepting my invitation there, John. As soon as I saw the video on Palisade with Tom, I said, man, John is so cool, so like different than the other voices we hear. Not that there's wrong with anybody, the way they pitch or they talk, but I said, I beat you right after. And I said, man, I have to finally, like my idea of having like a conversation between the fundamentals, or I know even technical, you're not that bad there. I've seen you post a few things. So,
well, thank you, Patrick, for the invitation. I know that there's actually a degree or diploma you can earn for being a chartist. So I'm certainly not at that degree.
Okay, I see you're listed on TSX, NEO. Okay, let's go on the TSX. Oh, you're not on the venture, you're on the TSX.
Yes.
So what is I know there's prerequisites, because I remember back in my early days, TSX venture was like $5 and less, but is there like how involved were you into having listed the Silver Elephant on the TSX there?
Yes. Well, Patrick, usually companies junior company, exploration companies start on the TSX Ventures. And TSX Ventures used to be a different company based domiciled in Vancouver. So it's a bit of a history in the past. Then the Toronto Stock Exchange purchased the TSX Ventures and renamed TSX Ventures. I think the basic point is TSX Venture has a lower bar of entry than the TSX. So for example, don't quote me on this, but in general, TSX, for example, if you're in the mineral exploration business, even though the TSX and TSX-V neither requires a company to be cash flow positive, but same can be said about NASDAQ and NYSEMX. But for the TSX, your property has to be more advanced stage. So
Okay.
like a feasibility stage rather than just a very grassroots. Another requirement for the TSX is a TSX-V. You can list a company, a mineral resource company with, say, a minority shareholder. So there is some ownership requirement on the TSX. And in terms also working capital, for example, I think TSX has more stringent requirement in your fulfilling the capital working requirement as part of the listing requirement. So
Wow.
overall, TSX has a higher bar for entry than the TSX Ventures. So for ELEF, we started out as a TSX-V and we graduated to TSX about maybe 6 years ago.
Okay. Okay. And does that like, are certain funds like that buy miners, uh, are some restricted? They're not allowed to buy on the TSX-V. They could only buy on the TSX. Does that game of fund flows, does that help you because you're in the TSX? Because some funds they're not allowed.
Used to be that there are some investors frown upon
Yeah.
issuers on the TSX Ventures because as you know, Patrick, there was the Montreal Stock Exchange and there's Vancouver Stock Exchange, etc. And nowadays, with the good penetration of technology in various platforms, as you know, Patrick, I think not only till about maybe 5 or 7 years ago, it was very difficult to trade, at least for Americans or for Asians on different platforms. But now on E-Trade and on Interactive, you can literally trade on 30, 40 different platforms all around the world. So I really don't think there's a big difference on sort of investment funds are forbidden from investing in the TSX Ventures. However, just based on my experience, there are some investors that cannot invest in stocks say under $1 or under $3, or stocks that are under $100 million market cap. So I think the market valuation and the stock price have more to do with restrictions for investment.
Yeah, because it's funny because the market cap, I've always like, let's say it's a weird because under $1, but you could be on the dollar, but if you have you don't have a lot of shares outstanding, your market cap could be huge, right? So it's
Yes.
I think it'd be more logical just market cap, because sometimes I don't get the game, like the psychological game of, well, I think I understand it because some people if the penny stock, oh, it goes up 1 penny, I double my money. But I honestly, I used to never look at market cap, even as a technical trader, but I still now, I like opening the tab. So you see at the bottom, I put a ELEF. So I see market cap 76,000, 76 million. It kind of gives me a clue of the size of your valuation, because sometimes it's tricky. You have a $300 million market cap and the stock is worth, let's say 10 cents. I've seen like crazy things like that.
Yes. And you know, a couple of things. Liquidity, besides the market capitalization and the share price over a certain amount, like $1 or $3, liquidity is also a big criteria for institutional investors. That aside, I think, Patrick, I'm 47, and so I will be below the baby boomers, but I think I'm the Generation X. And after baby boomers, before millennials, the new generation investors, they're, they don't learn a lot of fundamentals, Patrick, unfortunately. So it's not unusual. It's quite often people would say, well, I know this company has much better fundamentals. They're producing cash flow. How come they're trading at 20 cents? You're trading at 55 cents. So they don't even know the basics of not to mention ounces and pounds, but they don't even know the basics of excuse me. They don't even know the basics of market valuation, capitalization is number of shares times the share price. So that is the sort of the reality of the world that we're dealing in.
Wow. So I don't know what that like it's like the basics. When I started trading at the beginning, I don't think anybody starts in technical analysis, because it's hard to remember like how it was at the beginning, but at the beginning, we start having a job, you have a spare money, you have 5,000-10,000 in your bank account. Okay, I want to make money. Then the first thing you do, it's like when I lived in France for many years, and what I've learned is the first restaurant you see is the tourist trap. Never go there.
Right.
So because it's on Champs-Élysées, the most expensive one. And usually the best restaurants are the best. They're the niche ones. They're hidden in an alley. And it's trading the same thing. So you're there. You Google stock trading, and you're gonna follow maybe on penny stock forums. You're gonna follow a whole bunch of stuff. Whoever has the best, like let's say marketing, you're gonna follow on them first. And then after that, there's a high chance that you're just going to click buy, and you're going to go on a forum, and you're going to see a few people saying good comments, and you're going to probably buy the first thing you see. But that means you're buying with the crowd, probably maybe at a higher price point. So over the years, I've realized that with charting, it gave me the edge because I was able to spot stocks where people say, it sucks, nobody wants it.
Yes.
But let's say I could see technically that people have been accumulating for years. So let's say I look at the silver elephant, okay, downtrend from 2011, but after that it based. So from 2015, sideways. For me, this is just a sideways consolidation. So people have actually been accumulating, and now we're above inclining 1 year, or right below 1 year moving average, above the 3-year moving average, which is starting to turn up. So, but you can't see that in penny stock forums. If you don't look at charts, it's kind of weird because you're buying on the best argument that like let's say somebody has a cool argument, and then your reasoning is, oh man, it has to go up because of that argument.
No,
but it's so dangerous, man, because if that argument flies out, the price action goes down, you're on shaky grounds, because now you don't have enough emotional capital to hold on, because you don't understand what's like you don't understand, let's say, the fundamentals, or you don't understand the price structure, that actually this is just normal volatility.
Right. Well, I mean, three quick points, Patrick, just to end to what you were saying. Is a perfect example is just happened this week. The Fed stand pat on the interest rates and forecasted interest rates to stay, even though there's higher inflation than expected in the future, which the Fed sees as transitory. And the market knee-jerked on the announcement, the dollar dived, and then the dollar quickly rebounded on Thursday and Friday. So that's a perfect example of the buy on rumor, sell on news. Yeah. You talked about the first one you see is you buy. I think that's something to do with the market efficiency theory. But when you talk about the junior mining sector, where liquidity may not always be there, this market efficient theory might take some time to play out. And just much like Warren Buffett talked about, in the short term, the market is a voting machine. But in the long term, it's a weighing machine. I suppose in your restaurant analogy, it'll be in the short term, the restaurant, even though it sucks, the food, you can still have a lot of patrons. Yeah. But over time, if it's not good food, nobody's going to go and come, right? You raised a fantastic point about charting. I remember back when I was started in 1995, 1996, when I bought my first shares when I was 21. There was no stockcharts.com. There was no bigcharts.com. And it was very simple days. And so I just find it interesting now. There's so many tools available. Certainly, the availability of algo trading, right? It was never been made possible in the past. So there's definitely not a lot of tools available. And same for, on the same token, same for exploration business in the junior business. I just take an example. One day, well, more than once, I have guys that came to me with a project they want a joint venture, or they want to sell, and they're maybe 60, 70 years old. And then they would show me all the exploration that's done on the project, and everything was drawn by hand.
Wow.
Patrick. So you have the drill results, and it was just fascinating. So, the technology just advanced so much. in the last 15 years. But nonetheless, I digress a little bit. I mean, in the silver elephant chart that you showed, I think it's really the first time in the last 6-7 years that the company has stayed above. The company has stayed above. In the long-term chart, the company has stayed above like your 3-year average for several months already, right? So it hasn't really happened. Every time before when it gets to that 50-cent range, it get rejected, and now it seems to me it's reluctant to sort of go back to. It's sort of reluctant to go back down. So that's a pretty good sign, despite a fairly big correction in the junior sector.
Exactly. Jack, this is my trick, but you're right, because the restaurant analogy, it touches on so many points, because there's so many tourists in Paris that sucky restaurant could survive for years. And it's the same thing in the stock market, even like crappy stocks in a bull market. And we see it maybe in like the NASDAQ, and why is this thing going up? Why is Tesla keep going up? And like everybody's saying it's, but there's so much money. There's so many new people coming in now, like that have access to that trading, and they're just piling on, and it makes that the bubbles, they could survive until one day, let's say there's a rat in the kitchen, and then everybody flees that sucky restaurant, and they say we're not going back there.
Yeah,
but until there,
yeah,
they could keep their bad practices, because there's always a new customer that's going to buy.
And then furthermore, I thought your restaurant analogy is interesting. That, I mean, Taiwan now they're getting really cute in that these Google reviews, they'll give you an appetizer, right? Or give you like a coupon if you to write a good review, and then you to show that you write a good review. That's a lot of times like in the stock marketing and promotion in business, where there's a lot of people that might seem as unbiased, but in fact that they are. That's part of the reason, Patrick, I choose to do direct marketing. Meaning that I am drinking my own champagne. Everybody know I'm biased because I work for the company, rather than somebody that might seem unbiased, but in fact that they are. And also that, Patrick, in the restaurant analogy, much like the stock market, because it's all about supply and demand. Not only the stock charts, meaning not only the review of the restaurant is good or bad, but you got to see the number of reviews. In this case, it'll be the volume or stock. That is critically important. And I know we're probably getting into some of the ways we trade, but when I was doing investing full time, when I got out of the .com sector back in early 2000, after 6 years in that industry, I was doing quite well. I became a full-time investor. That's when I really started doing technical investing in the early 2000s. So I learned through the ropes. Is I would wake up every morning. Oh no! In the evening when I do my homework in Vancouver before I go to bed, and the first thing I look for is stock gainer. So I'm not even looking for anything else about the fundamentals of the companies or reading Reuters or CNBC. I just go to stockcharts.com and I will look for stock gainers, volume gainers, right? I mean, there's few ones like 50-day new 50-day moving average, but I'm not so much interested in that, because typically a lot of the news is already being baked in when something's taken out of 50-day moving average already. Same with another big trend is 50-day crossing 200-day. That's usually another big one. But however, because all the algo tradings nowadays, there are tools that will pick up 3 or 5 days before 50-day were to cross 200 days. So there's a little bit of front running and whatnot. So that I found in the junior sector for resource, one of the things I love the most is looking at volume gainers. And you scan over that, usually about 10 or 30 stocks will show up. And then I quick look at the market cap and that the company is actually a functioning company. And from there, I will look for the news, and I will love the ones that actually have no news.
Yeah.
With the volume gainer, and the stock hasn't gone up too much. So then I will call the company, and the companies that have no news, that is absolutely the best stock to buy. And I was doing very well in that regard. It just shows you the power of technical analysis, especially regarding to volume, which a lot of guys do not pay attention.
It's I don't want any news. Honestly, it's fun. My emotions get up, like the silver squeeze, everything when's going up. But the more you've lived through these swings up and down, even if you're in a bull market, like eventually, even if like there's peaks of euphoria and then it corrects, but it keeps going up because in the precious bull market, like the capital flows are too strong. So even if there's a lot of short-term euphoria, eventually like it resolves upwards. No news. If I want to buy, the best time is when everybody's fearful and when everybody says, "Ah, man, are you sure about gold and silver?" Like, and then like everybody's looking elsewhere. It's a famous quote there from Eric Sprott. You want to feel lonely. You want to buy when nobody's in the room with you. And then because when everybody wants to come in, that door is super small. And then that's when you have crazy explosions going upwards.
And you know what, Patrick? That's why Eric Sprott is such a good investors. So he is the contrarian within the contrarian market. He's the contrarian investor in a resource gold market, which is contrarian macro theme. I talk to a lot of institutional investors and hedge and funds. You know, they're handicapped in some ways, Patrick. So I'll show you why an individual investor and such like Eric and even yourself has advantage over the funds, because these funds, they cannot be they have to be in a crowd, because every month they have their performance. They have their performance. They have their calculations on the fund's price, and they have to answer to their investors. So they cannot do these crowded trades with discretion on the timing, and they have to say, hey, when I show silver elephant, the first question is, who else is invested in it, right? Oh, Eric Sprott, okay, I'm good.
Yeah.
But like if nobody else I think they're a bit of a crowd trade, and there's a reason for that, because they're handicapped in that regard. And so that's a very good point you brought up.
I always use I like to use also point and figure charts, like to remove like that Warren Buffett there. Sometimes the market needs more time to churn, and when I use a point and figure, it's like only like the price movement is sufficient. Then it adds a new column of X's or O's depending if it reversed, and you see over time. You see the tightness of, let's say, I took silver elephant there. Sorry,
yes,
but you see that it's tight. So even the volatility that we saw since 2015, it's condensed in a super tight range. And I like doing this. Finally, I'm doing technical analysis with you, just like I would do with Kevin. I'll replace you with Kevin. Kevin, I'm sorry. John's my new partner for technical analysis. And you could see sometimes more clearly breakout levels,
right?
When you on point and figure, like pure price action, and it's getting tight, super tight. But what I like is because sometimes there's a analysis by paralysis, because when the price action's not moving, then people, yeah, but maybe it's going to keep going down. Me, it's the volume here. When I see a lot of volume at this base, for me, a lot of the buyers, whoever bought up here, they either took profits or they gave up, and
right.
The dynamics of the business change. And that's like, and now this is just the new changes in hands. And if you don't do a new lower low, that means for me, the option is going to go upwards. Because if we want to do a new lower low, still possible. But right now, as soon as you slide up above this base, all these are fresh hands. There's nobody that needs to sell. So as soon as the price goes up, the bag holders, there's not that many. The time kind of fixes everything. Either they put their money in Bitcoin, they sold. But what's positive is you seem to have hit a floor here around also at this level. So if I would expect, if I would see a next bounce, I don't know my arc, but see, these are critical, important levels there. So
yes,
if ever it breaks above this line, then after that, I call that bullish transition zone. And you start getting momentum, because now what happens here, nobody is talking much about it except us in the silver space. But once you start getting up here, then you'll start attracting people. Oh, you made a 50%, 100% on silver elephant. And then when you get up, this is like the breakout line of like the point of recognition. So if you ever the price action able to go above, let's say 90 cents, man, after that, things could really start steamrolling here. Is that your 2011 high? 2013.
Yes.
So, John, how long have you been in with Silver Elephant?
I was the founder. So I started the company in 2009.
Wow. Okay.
So I
Okay.
took over a shell. So before the company was inactive in 2009, and I took over the shell. And you
I'm gonna
saw
put it
that
back.
as soon as we took over the shell, we're very active in our activities, and the stock came alive. And then 2 years later, the company go through. I mean, 2 years later, the market crashed, and the company endured almost a decade of correction. And so it
Where
was
did you
bitter,
buy?
it was bittersweet, but actually, we did backwards, right? It's a sweet, and then 2 years is sweet, and then 10 years of bitter. We stuck around, we hang in.
Yeah.
One thing, Patrick, I want to go back to you were saying about the charts. Usually, I like, the charts a bit like you're eating, right? So it constantly need to be fed news. It's almost like a sweetener. It needs to be fed all the time. So the company hasn't had news for the last a month and a half. And this is probably, I'll call the neutrality level. So given there's no news, if I go to Twitter, we search our symbol, there's nobody talking about our stock at all. And yet the stock is refusing to go down. So that to me is a good sign. And also, I'm looking at just, going back to sort of the theme of our discussion today on the fundamentals versus technical. Usually when I look at the company, I was like, okay, well, as I mentioned to you, I start with the chart, okay? I start with the chart looks good. And then I go to the company, I look for, so there are 4 scenarios. If the chart sucks, the fundamentals suck, then it's a company I wouldn't want to invest in. And then there is the chart where like the chart looks great, but the fundamentals I don't understand or I am not in agreement with, such as crypto. Then I say, okay, I don't invest, but I don't have the fear of missing out because we don't need to be right all the time. Like Warren Buffett said, you only need to be right 30% of the time and you make a big home run out of it. And then there's a time when the fundamental is right, but the technical is wrong. That is when a lot of the people suffer pain and suffering. And that is something I try to resist myself all the time because you thought fundamentals because you're ingrained, you're taught into this. And in school, you never are taught about technical. It's always fundamentals, always fundamentals. So it is the toughest to resist when the fundamentals is right, when the technical is wrong. You can dabble about it, but you want to do small quantities because you're bottom fishing. And bottom fishing can be detrimental. And even Renaissance stock operators have said he knows plenty of people who caught the bottom at the exact right time, but never will make a lot of money. But the best guys you want is the fundamentals are right. No, the technicals is correct, and the fundamentals you understood. And you can pinpoint maybe 1 or 2 reasons on the stock on why the stock's going to go up and why the technical is marrying on the fundamental. Elephant, it's the chart's looking good, but it's still reluctant to break out. And I look at the technicals is great, Patrick. I think we're very undervalued because we've been doing a lot of acquisition activities. For example, since 2017, the company's completely changed from it was 5 years ago, but there's a lot of still legacy investors, like you said, they're still selling the shares, right? So we need to wait for that to exhaust. And once that's exhausted, the new people have a lot of new investors that like the fundamentals, they're in for the long term. I think another good example to Silver Elephant, if you look at oil, maybe 1 year chart for oil, I think it's a perfect example because there was a lot of storage facilities back in March 2020. The storage facility was like an all-time high. Like there's some point people were talking about possibly all the if you put a 1 year chart, possibly all the storage capacities over got to be filled, including the boats and tankers, so eventually the oil break out right from the 40s to the 60s because there was a lot of selling along the way from the storage facility, from oil from the storage facility. So the knowledge I'm drawing with Silver Elephant is that the reason there's still people selling on the stock is because the company's been around for 10 years. So there are some legacy investors that are still furnishing the supply to the market, kind of like the oil.
It's man, I didn't know. I'm so like I was wondering like when you got in Silver Elephant, man. It must the emotions must have been insane there. When did you say in 2009 you got it?
Yes, that was exactly when the crazy things happened. Silver went from $15 to 50. So I lived through that.
Wow.
Yes.
Mommy, I made it. I'm rich. all this, you lived these crazy candles?
Yes. Yes. It was crazy times.
Jesus, let me see.
Right
how
around that
much,
time was when I started Silver Elephant.
when in August?
In October 2009.
October. Okay. Okay. You were still nice there. November.
Well, but at that time, we're not in the silver business. It was too late, Patrick. Silver guys or issuers are going crazy. I remember silver standard was around $40, and now I don't know what it's trading now. I don't trade silver standards anymore. But at that time, we're in the nickel business, and so we got in coal and nickel just before the explosion of these stocks. So I mean, we can talk about rotation even within the commodity sector. Usually, when the market is coming out of a big correction, like the financial crisis or like the COVID, gold and silver, gold tend to do the most well, and then followed by the growth sector, right? So coming out, there's a lot of the dollar rotation out of the dollar. So they're looking for maybe emerging currencies and for companies with liquidity like gold. And then after that, we'll be moving on to copper and moving on to oil, for example. So even within the commodity sector, there's rotation post-crisis.
Exactly. Well, that's why when you get new eyes to the commodity cycle, and people now, let's say they're looking at uranium exploding and or gold's lagging, but they forget that gold is the first one that started. So once you've lived through a cycle or two of a commodity bull cycles,
yes,
you understand exactly what's happening. Gold. Then sometimes silver a little bit, but copper they're close. Then a little later on during the cycle, you have let's say oil that starts sensing the inflation.
Rare earth, yes,
rare earths.
Yeah, then you get into smaller. That people start going down the food chain, right? They're selling Peter to pay Paul. They're looking for that leverage, and they would then move down the ladder. Again, this is a recurring thing, even though the movie doesn't play twice exactly the same. However, gold and silver, I remember gold started going in 2001 from 250 to about 400-ish. But silver didn't really make a move until 2 years later.
Yeah.
And so very much like, a bit more like 2009 and also like where we are. But interestingly, though, gold has underperformed in this cycle, in this rally, post-COVID. And in the last interview, I gave a couple of reasons. One is I think there's the management of the gold market is less proactive than was before. And secondly, because I think the advent of the cryptocurrencies really also exerted some pressure in gold. Because in the 2009 post-cover recovery of financial crisis, gold never dipped below 200-day moving average.
Never.
However, it is doing this right now. It is acting quite weak, which is quite strange. But then if you really follow sort of the futures market, I think there is a very strong concerted effort by some very sophisticated investors that are very actively managing the gold market and silver market. And that's why I was mentioning that the best time for silver last year, when silver was 17, I pegged a target at 30 before the end of last year, because it was busy leading up to the election. And I just thought that there's going to be a lot, the equity market, everything's going to sort of stay the status quo. I think they're busy. They're not have time to active managing gold and silver, but now the election is over. I was not as bullish on silver as I was in percentage gains for this year versus last year. But unfortunately, silver didn't take out 30. This year, I've said it many times, we will let the technicals dictate the talking. So in the case of silver, I've been saying it's 24.5 to 27.5, but 24.5 was based on the 200-day average a month ago. And now the 200-day average is moved up to about 25, 30-ish. So that just doesn't leave a lot of room for silver to maneuver. Now we're looking at a very tight trading band for silver between 25.5 to 27.5. So it's going to break out one way or the other, and let's see. And we'll not be surprised if it staged another similar event in July last year where silver can dip briefly to 22 to 21 to get rid of all the weekends and then start to go up from there. So we have to wait and see.
Yeah, it's like there's always I always mostly post like bullish charts long term, but there's like always like three scenarios you have to consider. There's the scenario where it goes in your favor. There's a scenario where people don't often, but it just moves sideways. Like you said, like the Buffett market just needs time. It's not ready and it's just moving sideways, and that freaks everybody out. And then there's the move down where there's some type of event and the market sensing a change and then it goes down. But you gotta look. This is another chart there. It's the copper to silver ratio.
Yes.
And I often look at like copper explodes, silver lags, and since it's a ratio, usually it could be a tight, like it could go back down. I have a feeling that as soon as copper slows down, then silver could start outperforming. And there could still be room here. Maybe there's a chance for silver to start outperforming, but you're right. Maybe silver is going to hibernate just a little bit more until copper really blows itself out. And then maybe silver could start outperforming.
Yeah, because copper, there's something, copper is an interesting market. I don't study copper as much, Patrick, but copper is seen as almost a investment. So you should have retail people in China that will buy copper and trade and store, because you can store copper. Silver is poor man's gold, but copper is poor man's silver. That makes any sense. So there's definitely a lot of active hoarding in copper, and copper market is heavily influenced in China, as is with iron ore. Not so much on silver for the Chinese hoarding. I don't know why. Maybe it's got to do with some import tax and whatnot. But you mentioned about the ratio of copper to silver, which I don't track too much. But I did do a fairly long analysis on silver versus uranium, Patrick. And it was almost came in by accident. But in the silver versus uranium market, I'm not looking at the ratio per se, but there is a correlation on the movement of silver and uranium. And I recall that silver peak usually follows within 12 to 18 months after the peak in uranium. You can see that, right? That's 2000. Can you lay copper? Can you lay uranium on silver within the same chart? I don't know if you can do that. Yeah. That would be great over, say, a 20-year period.
That's the most I got there.
Yeah, so you can see that, right? 2010. There.
Hold on.
That's a big run up. So now let me see. Which one's the uranium? Which one's the silver?
Uranium is the finicky one. It's the uranium peaked here in 2007. Yes. Had another peak in 2009, 2010. Yes. And once uranium peaked, it went up with silver.
Silver will peak about 12 to 18 months after uranium. That was my conclusion.
Yeah, from here to here. Yeah.
Yep.
There's some time.
Yep. Same with here. Look, back in 2004, there's a big run up there. 2006. Yes. Here versus there, right? That's another one. Look.
Yeah, here to here. 2008.
Interesting, right? I don't know why, but maybe people have. So now you're looking at a spike of and then also you see a lot of people are bullish on uranium. I personally am not, because I've done a lot of research on uranium. The fundamentals don't look as good, are not good at all. And that's why you see silver's fundamentals outperforming. Go back to our thing about fundamentals versus technical. It's eventually, Patrick, fundamentals still play a big role, but the technicals help you with the entry and exit points. I think that's the key point I want to drive at.
It's that's why I got to be careful, because I do so much charting that I don't want, because there's the thing I learned is if I look at my younger self, so if I look at a Patrick, a 20-year-old Patrick, at 25, I was completely thinking different. My experience changed, like stuff that I thought was impossible or like, it has to work that way. 25, I said, Patrick, you're an idiot. Same thing, 30 to and now like I'm 45. And I have to assume that at 50, that's why I'm trying to be careful. Like, I don't want to, oh, it's charts or nothing, because at 50, I might come to a conclusion, Patrick, no, I'm sorry, but fundamentals, maybe they're leading like the charts, or maybe it's a combination of everything, right? Like, that's what's fun talking about to you, because at the end of the day, I'm trying to think that it's everything. It's like,
well,
like
there's
said,
not. Well, Buffett is a fundamental investor. He's been extremely successful. So there's one way to leading to profits. I think that if nothing else, maybe to me anyway, personally, it's not, you don't need to be right all the time. So you can be right 30% of the time, but just make sure when you're right, you make a lot of money. But the 70% of the time when you lose, you just don't lose as much. So the market, I'm sure I'm talking the same with everybody that knows, but unfortunately people are not robots.
Yeah.
That market doesn't care about your profit or loss, right? I remember one of my coworkers say, oh, every time I go to Vegas, I always win. But his winning secret formula is he bet on blackjack. So he start with $2. If you lose $2, he will bet $4. And then $4, you bet $8 until he actually win like, 250. And the next one is $750. So that he always doubles up. Well, that's his strategy, has worked. So everybody's success formula is different.
But the double up, I thought about that strategy, but eventually isn't there like a house rule that says you like, you can't bet more than a certain limit? So you could try that game, but I think let's say you lose. Yeah. It's,
but you know what, Patrick, go back to your point. I just recalled, as I got in the resource industry, you're right. We keep continuing to learn a lot more about many things in the last 12 months, because everybody is being locked up and locked down and locked up is the same at home. So I have my own views on different markets. I used to take words from Eric Sprott and Rick Rules and Frank Justra and Doug Casey as Bible, but I think over time I've developed our own theme. It's kind of like reminiscent stock operator. He also mentioned about this cotton trade from Percy Thomas. Every time Percy talks something and about cotton, looks also good, but every time he buys, he loses money, right? So in the end, you got to follow your own conviction, because if you were to follow somebody like this silver guy, GV, gold standard guy on Twitter, and he buys the stock, he sells the stock, you follow him. But what if he disappeared? Then what are you going to do with the portfolio? So you got to have your conviction, just like charting too, right? Fundamentals, you have no control over fundamentals, but charting, you can set your exit and entry points. I think, Patrick, if you to go to say, is fundamental or technical going to rule the day? I would just say that there is increasingly more funds that are hedge funds that are algo trading that are extremely successful. I think one of the fund I follow a lot, and I think it's called Jim Simon. It's a Renaissance Technology, and he's a graduate out of MIT. He traded stocks back in the 70s and 80s, and his fund is one of the few that's fully automated. And they're not just looking for technical trends. They trade all markets, currency, commodities, stocks, equities, futures, everything. That they not only incorporate technical trends and historic things, and they have this huge, massive database of everything. So they even have fortune tellers, a horoscope readers, the tides, the moons, the settings. They have all this data. So, I mean, Patrick, you and I are small fish in the pond. They evaluate everything, the whole universe, and they do statistics correlations on all these things. And that's why I think, Patrick, maybe 5 years ago, technical can make you a lot of money. But unfortunately, if everybody follow 50-day to 200-day, then people are going to front run that, right? By 3 days. So there's nuances, and that's why there's a lot more fake breakouts and breakdowns, a lot more frequent, Patrick, as you know, than before. And also nowadays you can, like Stan Westerstein, you wait for the breakout to you make a position, but now you have to wait for the breakout, and maybe you want to wait for a couple of days to make sure it's not a fake breakout, and you want to front run them because all these funds are doing that. And further, the takeaway from that is you cannot win in these kind of markets, both fundamentals and technical, because the fundamentals, somebody else know more than you, okay? Because somebody's selling, you're buying, right? So that somebody else knows something. But the technical guys have a lot more computing power than you have, and they have a lot more data than you do, and a lot more correlations running, because in the end, technical is about correlation, supply and demand, and see what happened in the past is happening repeat in the future. You have to catch the macro trend. So you have to have a little longer horizon. Yeah. That's why I also tell the guys, especially with silver, if you want to do this day trading, algo trading, you're not going to win, because these guys are fully automated. They're going to take you to, I mean, Patrick, to the point, if you were to place even one lot silver in the silver futures, just one lot, all of a sudden dynamics of the market completely change, even for one lot. Wow. Because they know that maybe there's a bigger fund that's testing the market, right? So almost like you put a lot in there and the market would change. And then if you don't have a follow through with more lots from the same year, with the same pattern, with the same IP, with the same trading house, then they know your retail, and then they will then go back to what they're doing in their business. Jesus. So it's to that microsecond of trading that they are doing right now. So therefore, it's startling. It's absolutely startling. So the first of all is fundamentals is, if you don't follow technicals, you're flying blind. Fundamentals are really, to me, not important. If anything, you'll miss some trades, because what I mean by that is something technical looks incredible, but fundamentals are not good. But that's the fundamentals you know. Now fundamentals that's yet to come. Exactly. So a lot of times fundamentals actually do handicap. So long as you follow the technical with the good exit strategy, you can actually make much more money. And certainly there's huge amount of trades where I could have got into, but I don't like the fundamentals, right? So, but then, you know what? I don't miss this. I understand the reason I don't like this. You know, maybe something fundamental came up eventually of which I didn't know about. That's okay. Kudos to them, right? Because I didn't know. So I rather get into the market, such as the resource industry, especially in mining, where I know the fundamentals quite well. And then I use the technical to help me with the exit and entry point.
Man, it's a lot of stuff. Yeah, you said there. It resonates a lot, because that's like a part of Stan's book again. It's all these analysts out there, all the computing power. At the end of the day, all these on the longer term, all these super robots, all these super fundamentals, all these analysts, they have to buy and sell. And that's like my reasoning right now. And for the past 10 years or 14 years is, I'll see it in the chart when it's ready. My timing might not be perfect, because I'm looking at a bigger chart. So let's say I'm on quarterly candles or monthly candles. Of course, if I'm off by a candle or two, or let's say like Silver Elephant's been consolidating, let's say for 3, 4, 5 months, that's a long time in somebody's lifespan. But that's the price to pay, I find, to maximize my chances of being in a successful, meaningful long-term trade. Because I did all this scalping and short-term trade. It's a coin flip. And then at the end of the day,
you're not making much.
Some days I thought I was God. Some days I was a loser. But when I look at my
there's no consistency. Yeah.
I did so many trades, so much headaches, and for not that much more gain. So it's like sometimes I work with Steve Penny there on the Silver Chartist, and he says a buy and hold strategy at the correct time is often a lot less headaches and will outperform pretty much most ins and outs and trying to time you have to realize, sometimes I realize, if you think you're within 1 or 2 years of a meaningful bull market, let's say in silver, like the weight of evidence, all the charts are pointing to commodities are too low. You pull the trigger and you have to hold it out, because the more you wait and you catch in later, or you try to trade in and out and you miss, that's time of your life you're never getting back. So early bird gets the worm. Like, start positioning yourself. You don't have to go crazy everything at the beginning, but at least you're at the beginning, and start positioning yourself intelligently at the beginning. Because,
well, Patrick, here the interest rate right now is 0. Okay, so the bond investors, they're speculating, because if you hold the bond to maturity, half of the, 40% of the time you're guaranteed to lose money. Like some bonds are yielding negative. You're speculating on that. Housing market in Taiwan here, the yield for rent is like 1%. So you are speculating on capital gains. The equity stocks, the PE ratio is never being higher, like 30, 40, right? And the historic PE ratio is like 7 or 12, according to Warren Buffett. So you're speculating. I really sort of a little bit tired every time you hear, and I used to not follow the technical trends, and they say, oh, the stock market is forward looking, right? So that's why when the stock market is low, you want to buy now because things are going to get better. And then all this gibberish talk. And then you know what? The point I want to drive is this. First of all, 0% interest rate, you're speculating, and you have to follow the money flow. And the technical trend will guide you as to where the money is going from and then where the money is leaving from and going to. Secondly, I talked about this in another interview, I think with Wall Street silver investor on Reddit, is the reason this GameStop scenario drew a lot of attention. But what really caught my eye was Citadel, which is a hedge fund. I think they lose something around $3 or $4 billion, and they were able to marshal so much resources behind them to recover their loss, which is only a few $1 billion. They called the SEC halted. I mean, then they called their buddies on this Robinhood to hold the trades of GameStop, and then you have Elizabeth Warren, the senator, talking about protecting and investigating into Reddit to protect. So have all those things happening just to rescue a short position for a $3-4 billion position. So that gets me thinking that, you got this hundreds of billions of dollars hedge fund, they're making directional bets on the market, right? On equity, either up or down, short or long. It's conceivable, Patrick, that everything is somewhat orchestrated, meaning that the corrections you see in the market is just an overall narrative context to sort of make the market look normal. But the tops and bottom are called also. I mean, it is a managed market, not just in sense of silver. So the positioning of the commercials play a huge part. But then I don't read too much on the accuracy of the CFTC's commercial COT positions. However, that just tells you got to pay so much more the attention on the technical trend with the volume. And however, I mean, when the Ray Dalios or when these hedge funds come out and talk about the bearishness of the stock, they're already positioned into selling, right? So you just, again, you just got to be careful about reading the news and fundamentals. You really wanted to follow the technicals, given so many, given that the market is so actively managed. And that GameStop is very, very illuminating on the collaboration, just put it that word, of Wall Street, of Washington, D.C., and of regulators and of all the powers that be. Another example, Patrick, Nancy Pelosi bought like $10 million of Microsoft. And then a week later, Microsoft was awarded a $20 billion software upgrade contract. And he bought some Tesla options, millions of dollars Tesla options. What happened? The U.S. government mandate all electric vehicles, government federal vehicles to be electric vehicles. So that's another telltale sign that you actually don't know. Somebody's buying of which you think was not a good stock to buy, but somebody's buying, they have their reason to buy, and you don't know what the reasons are. So you always want to be thinking about what is on the other side of the trade. So, I mean, those are some of the things you think about the technical versus fundamentals. You don't have all the cards. If you don't mind pulling the dollar chart with the 50-day and 200-day.
Oh yeah, sure.
I just like one of the things I learned just recently to help you sort of manage or your emotional expectation on the market and look at the technical trend more objectively. So, for example, one of the things I always do, Patrick, is if I look at a chart, as I mentioned, the technical chart should guide you, or at least it guides me in the investment decision. Then you look at whether the fundamentals of this particular chart, of the fundamental company or stock or commodity sort of gels with what the technical is telling you. So one of the things I try to just manage my own emotion expectation is you try to buy 20% of the bottom and sell 20% from the top. A lot of the times you have a preconceived bias before you're looking at the chart. So for example, if I have a bullish expectation, if I think silver is going to go up, and I see this happen all the time, even including the best chartists, okay, including the most experienced people that I follow for 10, 20, 30 years. They're really at heart fundamentalist. But sometimes the technical chart really, they just use this to justify their fundamental position.
Yeah.
So what I mean by that is, if I fundamentals bullish in silver, and I look at a bullish silver, and I look at a silver chart, I will almost make up a reason for the chart to look bullish, right? So what I mean by that, Patrick, is, so if imagine, okay, so I think the easiest way is, if you were to erase the dollar chart, if you don't just pretend that it's not dollar, just pretend for a minute that this is a silver chart, okay? And then you're gonna say, oh my God, the silver is made a bottom in 2021, it's made higher lows, it's successfully tested this bottom trends, rebounded very strongly on a Friday. The 50-day is gonna cross the 200-day moving average. And when that happens, oh my God, it's gonna come free and it's gonna go to 120, right? You can easily do that. This chart could easily be a silver chart, but it looks like a dollar chart. So for these people who are posturing a bearish dollar stance, I'm just saying, hey, wait a second, you can turn it around. Imagine looking at a silver chart, you can actually write a different storyline behind this chart. Similarly, if you look at the gold chart, if you don't mind, Patrick.
I have a lot of gold charts. I could this one though. No?
No, if you look at just any gold chart, you go to stock charts and just type gold.
Okay. That's it. Daily?
Yeah, 1 year chart or 2 year chart with the 50-day and 200-day. Yeah, this is gold chart, right? Yeah. So you say, oh my God, you see, if you look at, imagine, like, again, Patrick, if you think this is the dollar chart, okay? Yeah, dollar made its top in July last year, and then it's making lower highs, occasional fake breakouts, and it's well within its downturn, right? If you draw a trend line, right? It's within the trend line, it's looking very, very bearish, and it's way below 200 moving average, and it's going to soon break beneath the 50-day moving average. I mean, Patrick, you can clearly see somebody make a bearish case for gold. So it can go a lot of different ways. The only way to tell is, you got to let the time to play out. One of the things I would say is, I'm making those analysis because the cartels and the people that are managing the market, they are making the chart looks like this. So they're deliberately making these charts look like this. So try to convince you that this is a market. Then you have the direction, unidirectional traders, right? Like the hedge funds, they look at the chart. They're like, the chart doesn't look any good. The gold is the barbaric relic and it never didn't respond to inflation. So I'm not going to buy this trade. So there's a lot of different dynamics that are going on. That's why, the technicals are good. However, here's just where the fundamentals and technical really is a good marriage. And that's why, again, I go back to what I was saying is, the dollar really hasn't shown its hand yet. And same with the silver and gold market. So if the dollar were to really rebound and have the 50-day cross 200-day and then go up more through the summer doldrum, then you could be potentially looking at further sideways actions for silver and for gold. In the case of gold, it would be oscillating around 50-day to 200. And for silver, it'll be, around that $23 to $26 range. Does that make any sense, Patrick?
It makes total sense.
It is a very, very useful tool for me because that is still a mistake that I see so many people still make. And that is just something I recently caught up just to manage my own psychology.
It's that's why there's recency bias and there's direction bias, like you said, and that's a trap. That's why to make to try not to fall in that trap, there's two things I always do is I always redraw my charts. So previous lines that I put, I try to redraw them, because sometimes you, like you said, you could only see, you just see that breakout line, but you don't see that it actually broke down. You know, like you could look at the technicals, which does your.
You're looking at it through a color lens.
Yeah,
yes.
always. But we're it's like humans, like especially if you have a position. If you have no position, it's a little easier.
Yes.
But as soon as you have a position, you're lying to yourself if you're not biased. But there's tricks to do that, because that's where the concept of weight of evidence that I come in. That's why I have nothing against cryptos. Like fundamentally, it's a great coffee table discussion. But the problem is with cryptos or Bitcoin, I have a 5-year chart, or 2017. I have nothing. I have no data.
Right.
Silver, gold, I have 200 years of data. I have 40, 50 years since 1971, the Nixon break. I have, like you said, those hedge fund, like those supercomputers, they want correlations, right?
Yes.
Well, I have all these correlation charts. I do the best I can to analyze. I have weight of evidence. So when I have my position in, let's say, silver, gold, and I have my 8-year cycles, proven 8-year cycles that have repeated for 3-4 decades, my confidence level, it goes up. So when there's a drawdown and we're below, like you said, let's say they manipulate the price, let's say below that 200-day moving average, it's, for me, it's a hazard, because it could easily tumble down, gold. There's no, it's below 200-day declining. That's scary stuff, man. You don't want to be there, especially
exactly.
in the bull market.
That is gold right now, Patrick. Unfortunately, that is gold market. It's below 200.
It shouldn't be there. It shouldn't be there. And I did some charts where it closed below. It never closed below its 18-month moving average in any of the previous bull markets, and it did it this time.
Yes.
So it's on shaky terms right now. The market's sensing.
Yes.
It's pricing in something that we're not understanding right now. That's why you can't be hooked to fundamentals, because the reason why, negative rates, gold has to go up. I just did a chart yesterday. When negative rates, they bottom, that's when gold tops, and that's it, game over. And
yes.
So you gotta,
but unfortunately, Patrick, silver is a little bit tricky, even though silver trends gold, but silver also trends copper, right? And copper is breaking out. That's why the dichotomy of silver, that's why I don't have a very clear call. That's why I've been repeating myself. Silver is going to go between 24 and 27 and a half until otherwise. It's like a seesaw, right? So the game is only like, it's keep going left and right. So you don't really know until it tilts to a certain direction, then it's going to go. One thing, Patrick, you had mentioned about not enough evidence for not enough historic tracking for cryptos. I read Westenstein's book, I think around 2007. No, not before that. I read the book around 2004, maybe even before that, during my times after I retired, semi-retired from Silicon Valley. So I was a young kid, right? Nothing to do, just doing reading. He mentioned about, it's interesting how the stock market psychology work. And I've been talking many times that silver, for silver and for every commodity, the industrial users is a price taker and the investor is the price setter. When the price goes up, more people buy it because they're reinforcing their gains. They feel more comfortable. So it's a reinforcing psychology. Westenstein said that typically it takes a stock ascent slowly up and then blows off, right? Just like all the chart for NASDAQ and for cryptos and all this market. But the thrill is on the downside. So Stan talked about when you breach 200-day, that is the time you want to average in. So the downside happens a lot quicker, and the scale and precipitous fall is a lot faster, again, to do with human psychology. So if you look at the Dutch tulip, I think it's in 1700, it took about 3 or 4 years for it to go up. It only over like 3 months for it to come crashing down to literally zero. And interestingly enough, that was the removal of the margin trading for tulip and the Black Plague that stopped people from going into the market to bid for tulip. So it has nothing to do with the fundamentals of the tulip, but some circumstantial events that really caused the collapse of the crypto. Yeah. And Patrick, I will just go on the limb, and this is record of May the 1st. Eventually, I think what's going to take down crypto would be the revelation of Tether, the stable coins.
Yeah.
They don't have the dollar backing them up. And really quick on Tether, I don't want to go to the fundamentals, but if you look at all the cryptocurrency trading volume on a daily basis, is around 200 billion. Okay. I don't want to say it's dollar because it's not $200 billion of cryptos being traded. 200 billion units. And of that, Tether on a daily basis is over 150 billion. So that just tells you that this whole crypto coins is traded within its own community, closed circuit community. That the dollar and the fiat currency, the dollar or pound or euro, only play a very small part, 20%, maybe even less of the overall trading. So the question then becomes, I think eventually if it unravels, it could continue to go, right? As crypto trade higher, sucks more dollar in there, so the game can keep going on. But I think what's going to really undo the crypto is the collapse of the Tether. And what it collapsed is the ratio of Tether to dollar, the link on that from 1-to-1 to maybe 10-to-1. So you could still be looking at crypto trading at 50,000, even 100,000, but that would be in Tether. That would not be in dollars. The dollar could be, you could chop a zero when it gets converted back to the dollars. Wow. And in the meantime, Patrick, there's unquestionable, in my view, and I'm speculating, that whoever that has the dollar exchanged, whoever that gets the dollar by exchanging their newly minted tethers, they're cashing out on the back end continually. And as the crypto Bitcoin price keep going up, it's going to take fewer and fewer cryptos to break the bank because they don't have enough dollar to service the conversion of Tether back to US dollars. And you risk of that happening every time somebody cash out of their Bitcoins. So that is my take. When it's going to break out, we never know. But when it breaks, at least we know the reason for that. So that is a market I studied very well, very long, and just not got into. But you never know, right? But there still could be a lot of upside. Could it go to 100, 100,000? Could it go to 150,000? Nice. Hey, Patrick, let me, if you don't mind, we'll switch the topic a bit. It's almost like a concluding chapters for this conversation is, if we go back to the fundamentals versus the technical, and I want to go to the fundamentals, the big picture. You know, we talked about we cannot be the algos, right? They're front running, but even the technicals we cannot really beat because they're front running you. And you cannot rely on just the fundamentals because they're fundamentals that you might not know. So it's almost you want to be in the technical, but you want to actually have a little bit of the fundamental sort of mindset to it, so you can beat the algos and the unidirectional, the Renaissance technology. If you look at the big theme, I've been doing a bit of studying because we have a lot of time here on my hands. On the hydrocarbons, it was interesting, Patrick. I read this. Now you're not going to get it a lot of different places. Like if you're in Europe, okay, or either in Asia today, the main form of transportation is rail, is trains. In Japan, for example, too. But United States, cars. And why is that? People ask, why is that? Well, if you follow the stories in the 1930s, that there was a lot of lobbying by Standard Oil, which is now the Exxon, and Shell. So they were lobbying, they were buying, Patrick, they were literally buying train tracks and these train cabins, these train carriages. So there was this decision point between highway and trains, and America opted for highway. So they started building crazy highways from the 30s, 50s, 60s. And then from there on, it was the hydrocarbon that dominated the world economy for the last 50 years, 70 years, over the last almost 100 years, Patrick. It's crazy. So the war, let's be clear about it, the war is all fought for hydrocarbons, okay? I mean, there's genocide everywhere. In Rwanda, you don't see people going there and do anything about it, right? But they go to Libya, right? They go to Iraq, and they go to Saudi Arabia, right? There's strategic. So why is that? It's all about oil. The world revolves around oil. And the reason is the world is all about energy. It's all about energy. Now, if you look at what's happening moving forward, it's very, very clear. The world is moving away from oil for whatever reason, like climate change, whatever reason. It's very clear, right? Just like back in the 20s, they choose between highway and trains. There's a directive to move to highway, not trains. Here, you have a directive to move away from oil to power, electricity, electric power, electric vehicles. So the world revolves around energy. And if you look at the energy consumption, and this is an absolutely fascinating topic, the world right now, the energy consumption on a worldwide scale is increasing at around 5% per year, 5%. And that percentage increase is increasing. That's the annual percentage increase is increasing. Okay. Why is that? If you look at the United States, an average US person is consuming today 1,000 watts. So that's 1,000 joules per second, okay? China is consuming 450 watts, just roughly half of US. India right now is consuming less than 100. It's 1/10 of the United States. So you have this United States power consumption is leveling in the last 10 years at around 1,000 watts. But the world is catching up to it because the United States is around 7% of the population, 8 billion, 300, 400 million out of 8 billion, 6% population, but they're consuming 15% of the world power right now. That thing's going to level off. So you have India, Africa, all those populous countries, Indonesia, on an annual basis, power consumption is increasing at 6%. And that's equivalent of 150 nuclear plants every year need to be built. It's not sustainable. So I think first of all, you're going to talk about, okay, the people need to consume a lot more power today. And then you look at the power needs to be created not through fossil fuel, oil, or nuclear. It has to, now is solar. The lowest form of power production is solar at 3 cents a kilowatt hour. A square kilometer solar can produce 1 gigawatt. So a 300 square kilometer area in a corner of Utah can power the entire United States. So let's back up a bit. I think the main thing going from here, Patrick, is away from oil, moving towards electricity. You want to invest in electricity. So how do you invest in electricity? Solar. So it's about solar, but the power is all about the power generation, Patrick, and power storage. So the power generation is solar in the future. There's no question about that in my view. And solar requires silver, okay? But then to store energy for mobility used to be oil, simple, right? But now it's not so simple. So you need storage, battery storage for energy. So that's lithium, that is nickel, that is cobalt. So, and then for the grid scale, for the huge battery, for these solar farms to increase the capacity utilization, in case to store power at night, to use at night, you need vanadium batteries. And that's why Robert Freeland talked about that. If you look at the periodic table, it's got like 100 elements, 130. There are only maybe 8 or 10 elements that are going to be a huge winner in the next 5 to 10 years. And I really do believe in that. Robert Freeland also talked about catching the big trend. If you're in 1980, if you'd about bond and correctly forecast the deflation, you're going to be a 30 year that's yielding you 15% a year for 30, 40 years. And now you cash out today. You don't need to lift a finger. Patrick, absolutely the same. It's physics. It's inevitable. The world is moving towards electricity, electrical. This is a electric revolution. This is an electricity revolution. We'll have electrification revolution. It is happening right in front of our eyes. Patrick, look, the other thing is you can say, oh, John, for the same analogy, you can buy food, right? And you can buy everything not everybody needs. That is true. And that's why Bill Gates bought the largest farm landing position in the United States. But I am more bullish on power generation and power storage than food. The reason is this: India, average person consumption of food is 2 kilograms per day in water, in whether you want to eat wheat or gluten or proteins or fat, whatever it is, around 2 kilograms a day. That is about the same with India. So there's not an upside for India for food. You know, people are relatively well nutritioned, but the upside there is for India is power side, you know, gadgets, right? And just all form of power. And the last point is, you know, I talked about the United States power consumption is leveled off in the 10 years, but if you were to drive an EV for 1,000 miles a year, that's going to add another 250 watts That's another 25% increase. There's no, I mean, Patrick, there's no power there. It's just not there. It is not there. And you know what? These silly, stupid analysts, they're saying, oh, 20-cent kilowatt hour, and they're doing comparison on power and say, the Tesla ownership power, you only need to buy $200 worth of power per year is oh, it's garbage. There's no power. You're going to fry the grid. If you have a EV penetration right now, it's at 5%, go to 30%, which is the conservative forecast in 10 years. There's no power that exists. You're going to need massive amount of solar. Forget about uranium, Patrick, because the amount of land you need to create a uranium power plant, you can take that land and use solar farms. You can produce the exact same amount of power, and you don't need to build a $10 billion 10-year deployment. 18 months, you're plugged in the grid. It's about power generation and power storage. Power generation is all about solar, which uses silver. Power storage is all about, for grid, for these big farms, it's all about vanadium. And for mobility, EVs, it's all about cobalt and nickel and lithium. And obviously there is the transfer of the power, and that will be copper, as you know. I am not as big on copper per se, say nickel. I think nickel is bigger bang for the buck because I don't see this big, huge interconnected grid. The world is not going to work like that. It's going to be a more sub-grid where you have energy storage and sub power generation, because you're not going to have a big power plant that's feeding all the little towns and cities. You're going to have either it's wind or solar, or if you're natural gas rich, you're build natural gas plants. So it's a lot more distributed power model. There's something that investors should take a lot of thought into that and make the right bets and make and then let them ride. And that's really starting in the end. My plug on Silver Elephant is we invest companies, we invest in projects for the long haul. We're being around, and we're well financed, and we're big into silver. We're big into nickel, and we're huge into vanadium. Patrick.
Wow. Well, honestly, the macro landscape fundamentally, somebody I respect very much who does charts. One time I was chatting with him, and he was telling me said, "Oh, I want to do a podcast with him," and he said, and then we're talking about silver, and he told me pretty much what you just told me, and I had shivers. I said, "Jesus, man, this is if the technical analysis, the commodity cycles are just starting." I don't think this is sell the news, because your speech, I don't think people realize the amplitude. So I don't think this is, if you would tell me this story when silver's already at $50, I'd say, maybe it's time to sell, but you're telling me this at rock bottom, close to 1 year moving average. We're almost breaking down for crying out loud, So man, this is, look, I'm not it's a beautiful story, but it's the charts are supporting that macro landscape for sure, the need for silver.
Well, I think, Patrick, it's like this, right? For commodity market investment, big thing, it's almost like a light bulb. It's blue pill and a red pill. It's an epiphany. It's like a revelation. And that supports the theory. I mean, the evidence to support my theory or my thinking is, if you look at commodity, pick any commodity, maybe lesser for oil, because you can't really store oil that well. It's almost like for silver. If you look at silver, for example, in the last 20 years, how many years is silver up versus silver down or sideways within the 10% trading band? I would say probably, Patrick, out of the last 20 years since year 2000, probably 6 years out of 20 at the most. And then even, Patrick, if you look at from July to today, how many days are silver going up versus down versus sideways? Yeah. Probably, from July to August, September, right, last year, from November for a month, from February for a month. So my point is, when the market catch on to what I'm saying, you want to make sure you actually don't sell I made 20%. It's going to go bang, bang, bang. Like copper. I remember copper in 2002, it was 70 cents. All of a sudden, just boom, 120. And then it's going to stay 120. And it's like, boom, $4, right? So you want to be careful. Sometimes, I go back to the Just Livermore, Renaissance style operator. There are plenty of people that he knew called the exact bottom, where the maximum profit could be extracted. but invariably they never make real big money because they weren't able to sit tight. They weren't able to sit tight. But you got to have an exit strategy. Well, I suppose take some, even though I said market doesn't care what your entry point and what your profit is, I suppose it never hurts to take your original investment off the table so that if nothing else, not so much on the technical to maximize your profit, but at least it helps with your psychology, right? Patrick, like you said, right? If you have a big stake on it, if you're a margin, you know it's a correction, it's gonna go, but you just like, you have no choice, right? You're not calling the shots anymore. The bank called the shots. So you just don't want to put yourself in that position. I first learned my lesson from the 1997 financial crisis. I was investing in tech stocks, kind of like resource stocks back then. So I have quite a bit of history in that. So I tell myself I'm never ever gonna invest equity on margin. And then after I graduated in year 2000, well, not graduated, after the company I worked for got bought out in year 2000, coincided with the peak of the dot-com, so I was very lucky. Then I dabbled into the options market, right? And I called my timing wrong because I thought that dot-com's not going to go up more. So I lost a lot of money, like money that took me like 10 years to earn, right, Patrick? So that was a very big lesson for me to never get into the options market, because in the options market, the time is not on your side. So if you make the call wrong, I mean, you can dabble on it. You got to have a very precision risk to reward control. So you don't put all your eggs in options, because if you make the wrong call, you're gone. And there's a very good saying, you cannot make money if you don't play. And if you don't have money, you cannot play. So sounds very simple, but so that was my lesson on options. Personally, I don't do options. I might dabble on the futures, but I have a very sort of, it is a small amount of my money, but that is market. It's really to gauge the market. But most of my position right now is silver elephant, and it's junior market is in equities. Just like the life lessons that work for me personally.
And the faster we learned that, because everybody, they have 10,000 and they want to be a millionaire. It doesn't work that way, guys. You emotionally, it's like I could have bought Bitcoin at $5. My friend sent me an email, Patrick, buy Bitcoin. I was in France, it was €5. But the question is, I would have never held on to, he bought a lot. He never held on to 65,000, because what's happening in human psychology, like you said, 20, 40%, 100, you're going to sell at 1,000%. Unless you're already super rich, you're going to want to buy food, you're going to want to buy a car, you're going to want to buy jewelry, you're going to sell. So you have, like you said, you need.
Patrick, you know what? You can go back to reminiscent stock operator. Jess Livermore said, if you don't expect the market to give you the coat, like winter coat per se, because if you come in an market expectation to make money, you're going to lose. So instead, you want to look at the market as playing like a game. So you want to detach a little bit detachment from the monetary aspect of the investment, but treat it like an exercise that you can perfect, like playing basketball, for example. Your posture, your positioning, whatnot, and that the result is only the the production, is the fruits of your labor per se. So that I think, go back to the point. So how do you cash out? What is your exit point for silver, for silver, right? So the way I look at it is not maybe looking at silver market exactly, but I will look at the other market, like you talked about correlations. Like, for example, if the gold to silver relationship is at 30, which is historically the top for silver, right? And also for gold, that will be like a warning sign. You want to look at your so right now it's 70. And when it gets to say 30, and also Dow to gold ratio, that's another one. Yeah. And so there are some ratios and that can help you to gauge, hey, look, we're kind of sort of getting up there. You want to start thinking about that. And Patrick, you want to write that down, because at that moment, your brain, like your rational is not doing the talking, right? Your emotion is doing the talking. So just like drink and drive, right? If you don't take the key away, your emotions can get underway. So that's why I don't have a call on silver, like on the numerical number, like $70, I'm going to sell, right? So I buy my gold or my car. That's not the way I go about it. I would say, what is the interest rate at that time? What is government stance on commodities at that time? Is there a shift in the global monetary system, right? For example, Is there dollar standard shift in that? How is crypto doing? How is gold doing? How is silver doing? Are there other applications, adoption for silver in the industry, whatnot? So a lot, but I think more than anything else, it would be the ratio. I think that's the big one. On the ratios, different markets. If the NASDAQ is topping off, right, go some crazy, insane thing on NASDAQ, if NASDAQ crash, it's not going to be good for silver. I think you can see 2009, 2020. Those are plenty good examples. So those are the extra strategy you want to think about for silver is relation to other markets. And that's why you see this crazy people call $200 silver could happen. Yes, there's always a probability, but in a $200 silver environment, you're looking at gold at probably 3,500. You look at oil at 150. You look at NASDAQ, look at Dow at 25,000. I mean, there's just some things are just not in the cards. And for things to happen, evolve so quickly. And if all the markets stay where they are, except silver went to 200, well, God, I will probably be out before it goes to 200 because it's not, the market's not gelling.
Well, yeah, right. Because if silver goes at 200 fast and everything else stays the same, those ratios are going to be rock bottom.
Crazy.
You'll have to sell because look, I'm at an SPX ratio to silver. You have to sell because the odds are not in a continuation of that. Emotions will make you lose. So
sell that, buy some hard assets. So I mean, one of the things I also talked to myself from the 2009 financial crisis, when a lot of my 90% of my net worth is wiped out from the junior mining sector. I just tell myself when I make money, I'm going to put some money aside, not in the bank, in real estate. So I amassed 12 different homes and apartments all around the world. But that was in my 30s, right? And a lot of them are rotten and water leak and whatnot. So collectively, these investments doubled in price in the last 10 years, all around the world. And you couldn't make, some never went up at all and some went up. And all of a sudden you have COVID. So my ranch all of a sudden went up 50% in the last 6 months. Before a decade, didn't move. Price didn't move for 10 years. So, that speaks to the sort of a bit of merit on diversification because you never really know what happens and the trends could snap and it could go up and down. But in the case if silver really just go to 200 and everything stay where they are, I will cash out substantial and I will invest in other hard assets because I know the pendulum would eventually swing. So there's always an opportunity to look for another trade. It could be nickel, it could be something else, just as bullish. So silver is not the only bullish trade out there.
No.
Patrick.
That's why I'm going to have to, in my logo on Twitter, I have silver coins, but eventually, I'm a chart trader at the end of the day. So if silver, the run's done, it's not going to, when we see it go parabolic on the monthly chart, that's it, guys, let's go home. We're not going to catch a top. It's going to look great in hindsight. Oh, look, it went that high. But if we're smart, we're, like you said, 20% from the top there. That's perfect.
Yes.
Hey, John, I don't know if you want to tell me anything else.
No, Patrick, I used to speak at a lot of
episode we just did now.
Yeah, well, it's incredible. Thank you for the opportunity. Yeah. I used to speak at a lot of different conferences and also on television interviews. I don't have a lot to do that. I used to do a lot of charting and be a lot more precise in my technicals, but I don't. However, follow me on Twitter. Yeah. Patrick, you're a Twitter superstar. So let's continue the exchange and let's see where the dollar is going to head it in the next couple of months. And as far as silver, I think they're going to show their hands. The dollar, the dollar should go below 90, silver should take out 27.5. That's when the real bull run start. It may be in September because there's the proverbial sell in May and walk away, and we may be seeing some of the summer doldrum, but you never know. I think there's a lot happening in geopolitics, in maybe the guys caught up with these crazy deficit spending and whatnot. We'll see what happens and look forward to be back on your show, podcast again. When that 27.5 happens, maybe. I think that'll be a good time to re-adjourn our conversation.
For sure, John, I really